I need you to stop what you are doing right now and listen to me carefully, because what I am about to share with you is not a prediction I am making. This is not my opinion. This is not a headline I invented to get your attention. What I am about to walk you through is a documented, data-backed, analyst-confirmed scenario that explains how silver, which is sitting at $56 per ounce right now as I record this, could fall all the way to $46. And I am going to show you the exact chain of events that would need to happen to get us there, step by step, number by number, not so that you panic, not so that you sell everything and run, but so that you understand exactly what you are dealing with. Because the investors who understand the scenario, who can see it clearly without flinching, are the ones who make rational decisions while everyone else is making emotional ones. And right now, in this market, the difference between a rational decision and an emotional one could be the difference between protecting your wealth and destroying it. So give me your complete attention for the next 15 minutes, because this is one of the most important videos I have made about silver in months. Let me start with where we are right now. Silver is at $56.43 per ounce today, Friday, June 26, 2026. It is down 2.45% just today. It is down 44% in 5 months. It is down 54% from its all-time high of $121.67, which was hit on January 29th of this year, 5 months ago. We have given back more than half of everything silver gained in its extraordinary 2-year run. And today, something happened that every silver investor needs to understand. Silver broke through a series of technical support levels that analysts had been watching for weeks. And with each level that breaks, the next lower level becomes the target. That is how markets work. Support becomes resistance. And when enough support levels break, you start to hear numbers like $46 being spoken out loud by serious credentialed analysts, not perma-bear trolls on Twitter. Actual analysts at actual research institutions. And today, I'm going to tell you exactly what they are saying and exactly why they are saying it. The first thing I need you to understand is what $52 to $54 represents, because before silver gets to 46, it needs to break through that range first. Analysts at Trading Economics and several technical research houses have identified $52 to $54 as the next significant support zone below where we are right now. This is based on two converging pieces of analysis. The first is technical. Fibonacci retracement levels of silver's 2-year rally from $47 to $122 place a major support level in the $52 to $54 range. The second is fundamental. This price zone corresponds to where silver was trading in late 2025 before the massive speculative wave of buying that pushed it to its January all-time high. These are levels where real buyers historically stepped in. They represent a memory in the market, a price at which enough investors believe silver represents genuine value that they begin accumulating in meaningful quantities. For silver to reach $46, it would first need to break through and close convincingly below the $52 to $54 support zone. That is not guaranteed. It is possible, but it requires specific conditions to be met, and those conditions are what I am going to walk you through right now. Condition number 1 is what I am going to call the Fed hardening scenario. Right now, markets are pricing in an 89% probability of a Federal Reserve rate hike by December 2026. That is an already hawkish setup, but the scenario that gets silver to $46 requires this to get significantly worse. Here is how. On June 25th, the core PCE inflation data for May was released. If that number came in above 4%, it would give the most hawkish members of the Federal Reserve Committee the ammunition they need to argue not just for one rate hike, but potentially for 2. Fed Chairman Kevin Warsh has already removed all forward guidance. He told the market there is no roadmap, just data dependency meeting by meeting. In a world where 2 rate hikes become the expected baseline, the dollar index does not just stay at 101, it moves toward 105. And when the dollar index hits 105, the inverse relationship with silver becomes devastating. Every 1% gain in the dollar, historically, creates approximately a 2 to 3% loss in silver. A dollar move from 101 to 105 is a 4% dollar gain. That translates to 8 to 12% additional downside in silver. From $56, a 12% additional decline takes you to $49. You are already more than halfway to 46 from that single condition alone. This is not a fantasy scenario. This is the mathematical consequence of a Fed that hikes twice and a dollar that strengthens accordingly. And the data that would trigger it, a hot PCE print, was released literally yesterday. Condition number 2 is what I am going to call the Iran deal collapse scenario, and this one is more complex and more important than most people realize. The U.S.-Iran 60-day peace roadmap is currently advancing. Oil prices have fallen significantly from their peak above $100 per barrel, and that falling oil price has actually been one of the factors removing safe haven demand from silver, because lower oil means lower inflation, means less reason to hold inflation hedges. But here's the paradox that most people miss. If the Iran deal collapses, if Tehran walks away from the negotiating table, if the Strait of Hormuz faces renewed threats, if oil spikes back above $100, the immediate effect would be a surge in inflation expectations. And if inflation spikes at the same time that the Fed is already in a hawkish stance, the Fed faces an impossible choice. Do they raise rates aggressively to fight the new inflation spike, which would crush silver from the monetary side, or do they pause and let inflation run, which would also confuse markets and create uncertainty that historically hurts silver in the short term before it helps silver in the medium term? Either way, a collapse of the Iran deal in the current environment creates a short-term silver negative scenario. Oil above 100 again means inflation fears return. Inflation fears with a hawkish Fed means dollar strength continues. Dollar strength means silver declines. And if the decline from the Iran collapse compounds with the Fed hardening scenario, the combined force could absolutely push silver through the $52 to $54 support and into the $46 range. Condition number 3 is what I am going to call the forced liquidation cascade. And this is the technical mechanism that could accelerate any decline to 46 faster than most people expect. Right now, silver's technical picture is already deeply damaged. FX Street confirmed this morning that a death cross is forming. The 20-day moving average is crossing below the 100-day moving average. The RSI is at 33, approaching oversold, but not yet at the extreme levels that historically trigger algorithmic buying. The SLV ETF, which is the largest silver exchange-traded fund in the world, closed yesterday at $51.78, below its 20-day, 50-day, and 200-day moving averages simultaneously. This technical damage matters because of how modern financial markets work. A significant portion of trading in silver futures and silver ETFs is done by algorithmic trading systems that are programmed to sell when specific technical levels break. When the death cross confirms, certain algorithms get short signals automatically. When RSI levels hit specific thresholds, more algorithms activate. When ETF prices drop below their 200-day moving average, institutional risk management systems trigger automatic position reductions. These algorithmic responses do not care about supply deficits. They do not care about JP Morgan's $81 target. They respond to price and technical signals only. And when they all fire in the same direction at the same time, they create what analysts call a forced liquidation cascade. Prices fall faster and further than any fundamental analysis would suggest they should. And in a forced liquidation cascade, what looked like solid support at $52 to $54 can be sliced through in a matter of hours, not days, as stop losses trigger more selling, which triggers more stop losses, which triggers more algorithms. This is how markets overshoot to the downside, and it is exactly what happened when silver fell from $122 to $60 in the 5 months since January. The fundamental case for silver did not change, but the forced liquidation of leveraged positions sent the price dramatically below any level that fundamental analysis alone would have predicted. Now let me bring these 3 conditions together into the specific scenario that gets silver to $46, because I want you to see this clearly as a sequence of events, not as a collection of independent risks. It starts with PCE coming in hot. Inflation data shows core prices still running above 4%. Markets immediately increase their probability of not 1, but 2 Fed rate hikes before year end. The dollar index moves from 101 toward 103. Silver falls from $56 toward $52 on the initial reaction. That is phase 1. Phase 2 is the technical break. As silver approaches $52, the algorithms start firing. Stop losses from investors who bought between $55 and $60 get triggered. More selling hits the market. The $52 support, which was supposed to hold, gets tested with enormous selling pressure from both human sellers and algorithmic programs. If it holds, the scenario stops here and silver stabilizes. But if it breaks, if silver closes a daily session below $51.50, the next layer of stop losses activates. More algorithms go short. The forced liquidation cascade begins in earnest. Phase 3 is the Iran wildcard. At some point during this pressure period, news comes out of the Middle East that the peace talks are stalling. Tehran is objecting to specific terms. U.S. officials are making threatening statements. The risk of the ceasefire breaking down becomes elevated. Oil ticks up from $75 toward $85. Inflation expectations spike. The Fed's case for hiking becomes even stronger. And silver, which was already under technical and monetary pressure, now loses its last remaining support. The hope that the Iran deal would stick, and oil would stay low, and inflation would cool, and the Fed would eventually relent. With that hope removed, silver has nothing to push back against the selling, and the path to $46 is open. Phase 4 is the final flush. Silver trades through $48, $47. The remaining leveraged longs who have been holding through the entire 5-month decline finally capitulate. They sell, not because they want to, because their margin calls are forcing them to. The last of the paper money leaves the market. Volume spikes, volatility spikes, and silver prints $46. For a brief, terrifying moment, every silver bull in the world is looking at their portfolio and questioning everything they believed about this metal. That is the scenario. 4 phases, 3 conditions, 1 very painful destination. And I am going to be honest with you, I do not know if this scenario plays out. I do not know if PCE was hot enough to trigger the first phase. I do not know if the Iran deal holds or breaks. I do not know if the algorithms will overwhelm the physical buyers at $52, or if genuine accumulation interest will hold that level. Nobody knows. Anyone who tells you they know exactly where silver is going in the next 30 days is not being honest with you. But here is what I do know. This scenario is not a fantasy. Every element of it is grounded in real market mechanics, real technical levels, and real fundamental conditions that exist right now. The analysts warning about $46 are not being irresponsible. They are doing their jobs. They are showing you the full range of what is possible given the current inputs, and you deserve to see that full range too. Now let me tell you the other side of this scenario, because every bear case has a flip side. And the flip side of the $46 scenario is actually what makes this moment so interesting for long-term investors. If silver does fall to $46, if all 4 phases of this scenario play out, what happens at 46? Something very important. The 6-year supply deficit does not disappear at $46. The JP Morgan $81 target does not disappear at $46. Goldman Sachs's $85 to $100 forecast does not disappear at $46. The 125 million ounces of annual solar demand does not disappear at $46. The 762 million ounce cumulative stockpile drawdown does not disappear at $46. All of those structural realities remain completely intact at $46. They were intact at $122. They are intact at $56, and they would be intact at $46. The price changes, the fundamentals do not. And at $46, with all of those fundamentals intact, silver would represent one of the most extreme disconnects between price and fundamental value in the modern history of this market, which means it would also represent one of the most significant accumulation opportunities for investors with the capital, the conviction, and the patience to act on it. Long Forecast has a Q4 2026 high target of $97. Goldman Sachs expects $85 to $100 for the year. From $46, a move to $97 would be a 111% gain. From 46 to Goldman's target of 85, that is an 85% gain. These are not fantasy numbers generated by permeable retail investors. These are the documented forecasts of the most sophisticated financial research institutions on Earth. And the lower silver goes before the reversal, the greater the percentage gain when those targets are eventually reached. I am John A.G., and the reason I brought you this scenario today, the reason I walked you through every phase of how silver could reach $46 is not to scare you into selling. It is to make sure that if this scenario plays out, you are not surprised. You are not caught off guard. You are not making decisions based on panic when you could have been making decisions based on preparation. The investors who get destroyed in markets like this are not the ones who understood the bear case. They are the ones who refused to look at it. They are the ones who were so committed to the bull case that they ignored every warning sign until the losses were so large that panic became the only emotion left. I do not want that to be you. Understand the $46 scenario. Know what conditions would need to be in place for it to happen. Watch the PCE reaction. Watch the Iran deal developments this weekend. Watch the $52 to $54 support level next week. And make your decisions based on what the data is telling you, not based on what you hope will happen. I will be here Monday morning the moment markets open. I will tell you immediately what silver is doing, whether the 52 to 54 support held over the weekend, and whether any of the conditions for this $46 scenario are materializing. Subscribe right now and turn on every notification, because what happens in silver over the next 5 to 10 trading days could define the next 6 months for this market, and you need to be watching every step of the way. I will see you Monday morning. Be ready.